In this video, we're going to show you how we saved a client unnecessary taxes that he would otherwise have to pay, but we did this without really using advanced strategies. What we did instead is we looked for opportunities to optimize. So when you look at the step-by-step of our precision process, what we did was we ensured that he had good books, which he does. And then we looked at other sources of income, which he had a W-2 from another employer and some interest income. And that's when we started calculating the tax projections for his federal and state. So instead of jumping into advanced tax strategies, which is what he thought he needed, we looked for untapped tax opportunities first, which is section 4. With Darren here, you can see the breakdown here. So we have W-2 income, which is a breakdown between his wife's income, his income, and another W-2 job that he has. He also has a K-1 from his S-Corp that flows in, and then he is actually maxing out his HSA, which is great. Right now, we're projecting at the standard deduction, which is married filing jointly as of this time was his $31,500. He has QBI deduction of $20,000. And his total taxable income brings him to $355,000. That brings his total tax bill to $70,000, almost $71,000 federally, and he also has some state income. He has some other taxes that he has to pay. So overall, he has to pay $75,374, and he's only withhold very little. So he's doing tax estimates, and he's done a quarterly tax estimate of $17,000 and some change for each quarter. But Q3 was where we saw, could we avoid or mitigate substantially a Q3 and maybe a Q4 payment without really diving into tax strategies besides the ones he's already implemented. We know he's implemented the HSA and he's verified that he's fully maxing that out before tax time, which he does have some wiggle room if he wants to focus on other strategies first, and he has up until the filing of his tax return to fully fund the HSA. However, he's noted here that he is going to fully fund it by year end. So we're great there. Now, the other thing is because his AGI is over $400,000, the child tax credits that he would normally get if he was under that are completely phased out. So what we looked at was, what are you currently doing that we may want to make sure we're tweaking and tapping into the full potential, or at least a lot more of the potential of those strategies. And this is where clarity and precision make all the difference. A template showing all the strategies he could do will not help him in this scenario. This client is also a little cash tight, meaning he makes good money, but a lot of his cash flow is spoken for, including the tax estimates that he has to do. One of his dilemmas here is, can I do other strategies to lessen the estimates, meaning allocation from tax estimates to other strategies? And we're gonna go over what we did here. We broke out, he's done $34,000 in total estimates in Q1 and Q2, which is great. He has some additional funds here that he's actually gonna get refunded because he paid a little too much into his Social Security and Medicare, which is common when you have a W-2 from an employer and then also W-2 from an S-Corp and W-2 from maybe another entity, which is what his wife has, a separate Schedule C that she derives some employment taxes from. They're gonna be able to get a little bit of a credit for paying more than they should overall. Now, what's great about this is we can see that his tax estimates pretty much cover what he should be paying. So $17,000, he'll probably tentatively is due $28,000. Now, the other thing that we would probably want to ensure is interest income or other dividends. He's stated that he doesn't expect anything. If it is, it's very minimal, maybe $100 total for the 2025 tax year. So what did we end up doing? We were able to mitigate his taxes to where he would substantially lower his taxes to $57,442. And how we did that is we projected out a little bit more in withholdings And then we saw how much he was actually contributing and if he contributed a little bit more into his 401k deferrals. So we did an additional $12,000 to his main deferral on his S Corp. So he has a W-2. If he did another $12,000 for the total year, he would be golden. And then for his wife's W-2, she's already just keeping the same contribution. She just has to keep doing that and she'll be fine. And that was it for that little tweak. Now, the other side of that is called profit sharing. What does profit sharing mean? Under your S Corp, you can contribute to that same 401k as the employer. And that is 25% of W-2 wages capped at a certain amount. He's not worried about the limitations there, and we're not necessarily trying to cap it out. We're just trying to see, can we eliminate the Q3 tax payment, or at least mitigate it substantially, which the answer is we are able to mitigate it substantially. We got it down to about $4,000 that he would have to pay in Q3, and Q4 completely eliminated. His profit sharing acts just like the HSA, where you don't necessarily have to contribute all of it within the tax year. You can actually contribute it the following year as long as it's before the time you file. So if he files an extension, he has some wiggle room there. We would recommend at least by February, March, he does those contributions, which that shows up on what's called the Schedule E. Here we can see we're going to do an employer contribution of $16,670. So we're maxing out his profit sharing that he's able to do, which is 25% of his W-2 wages, which lowers his net income from the K1 and allows him to take that deferral. That in itself is powerful, but let me tell you what's even more powerful about this is that not only were we able to do that, but because of the new tax bill that passed, we also can look at the Schedule A here and see that he is now traditionally capped at $10,000 for his state taxes. Well, now because of the new tax bill and because of his income threshold, he's able to not only take his mortgage interest and charitable contributions, which are significant, but now he also can take the full state income tax up to $40,000 and itemize it. The itemized amount allows him to take a larger deduction than he otherwise would have. Even with him itemizing before, he's still able to take a larger itemized deduction, which he was not aware of, and quite frankly wasn't actually available until a few months ago. So it was really important that whoever your tax planner is, that they're very aware of the updates and changes, whether that's with new court case proceedings or tax law updates. Now, he's getting this amazing itemized deduction. The other thing that's incredibly powerful is that not only is he getting a $79,000 itemized deduction, and he's getting a QBI deduction because he qualifies for that under his thresholds and income and the SSTB that he's in. The other thing is with that, he's also able to lower his AGI to the point that he's actually now getting the child tax credit almost to the full amount. So we could probably look at deferring just a little bit more to get him the complete $4,000 in child tax credits. If you're savvy enough, you should know a tax credit goes way further than a tax deduction. So if you have children and they're young enough to where you get the child tax credit, can you lower your tax bill to the point where you can get these tax credits? Because again, a deduction's great, but a deduction doesn't get you as far as a tax credit does. So that also saved him a significant amount. And that's how we got it to where he could, if he just pays quarterly Q3 46.48 and contributes the rest to his 401k and his profit sharing, he completely wipes out the $17,000 in Q4 that he needs to do. Now, when we show this to the financial advisor, she really appreciated the precision here of, oh, wow, before you're just jumping into these crazy tax strategies, which we will be working with her on and making sure as the financial advisor it aligns with their financial goals. But we're also focusing on deferrals in these high income years. And one of the things that we noticed with him was he was trying to contribute to a Roth IRA, which actually at his income, he's not permitted to do unless it's a 401k Roth, which didn't make sense at this moment when it came to mitigating his taxes and building his wealth. Later on, we can look at doing backdoor Roths or Roth conversions, but for now, he needed to reserve as much cash flow as he possibly could and have that be more focused on his wealth. The following year, he's probably going to look into doing a short-term rental, but because of this situation, it really got him in a position that really energized him and made him feel very clear about his path and what he's going to be expecting for his taxes. If everything is spot on, his tax return should look like this for the most part, if not exactly like it. There's always a chance that you forget about a dividend or some capital gains. Just try to be on top of it as much as possible. This is how we want to focus first on making sure your books are up to date, addressing all sources of income, doing the tax projections, and then looking for untapped tax opportunities that optimize your tax position before we say, hey, go ahead and buy short-term rental or invest in oil and gas or do a simple fee donation. Let's first do this because it may be enough. Then you can focus on the next step, which is advanced tax strategies. All in all, Darren, how do you feel?
Good, awesome. No, I'm super stoked. Thank you for taking a hard look at this. So it's best news I've had all year.
Awesome. Well, I hope not, but
Hey, saving 34 grand,
yeah,
that's not something to shake a stick at. So
that's very